All right, I think we'll get going here. So, welcome everybody. Welcome to our webinar on creating a college savings plan. I see a lot of good clients on the line here, a lot of friends of clients. So thank you for being on here. I do appreciate it. I also like to say congratulations to people that are on here. I know that's funny, but I truly mean that. We all have these crazy busy lives today. So you taking the time out of that busy day to be here and learn about, in this case, more about college savings plans says a lot about you. So we have a lot of good stuff to get into. So before I introduce Dan, just give you a little bit more about me. For those of you that don't know me, again, my name is Ryan Hitchcock. I'm a financial planner and partner at High Point Capital Group. High Point is a local Wisconsin financial planning and wealth management practice. Now, most of my clients are actually mid-career to retirement age clients. And some might think, why would a college planning webinar be appropriate? But it's actually comes up in a ton of different conversations, not only just new parents. It does obviously with them a lot, but I see it a lot in retirement planning. So grandparents for their grandkids talk about it a lot. I see it in aunts and uncles for nieces and nephews, godparents, you name it. I've actually seen it come up. So I'm mentioning that because anybody online here will probably get value from this conversation, no matter what stage of life you're in. So when talking about 529s and diving deeper into it, I thought it'd be appropriate to bring in my good friend, Dan Conti. He knows the most about 529s that I know around. So you'll be in good hands here. He's a senior regional director and a Wisconsin 529 specialist from Voya Investment Management. So you will be in good hands, like I said. And Dan, I'll let you take it away from here. Thanks, everybody.
All right. Well, thank you, Ryan. Again, to echo Ryan's comments, thank you, everybody, for taking some time out of your afternoon and spend the next half hour with us to talk about creating a college savings plan, how to save for college, what are some different tools that you can use. We're going to walk through that and hopefully answer a lot of the questions that you guys might have. And Ryan, thank you for not putting a photo up there of me. We don't want to start the webinar on a bad foot. So I'm happy that you put the little origami rabbit out there.
I gave you the squirrel. Real quick, Dan, I forgot to mention, I just do have to say we are recording this webinar and we do have the tax and legal and investment notice down there for people to see. So sorry, I forgot about that. Go ahead.
Perfect. Always important. So before I get to the next slide, Ryan, if you want to hand over the controls to me so I'll be able to go through them, we'll be good to go there. Just a little bit about Voya. So you guys see that origami squirrel and rabbit that you see on TV. Fun fact, their names are actually Val and Vern, in case you're ever wondering. But Voya Investment Management, we are a large company with three different tenets of the business, really. One is 401k, retirement record keeping. We're a top 3 provider in the country there. Investment management, which I represent. So the college savings plan that we run for the state of Wisconsin, as well as Iowa. And then we also have a large employee benefits part of the business. We are a Fortune 200 company with 7,000 employees in the United States. And a big part of my responsibility is being responsible for that 529 college savings plan in the state of Wisconsin. So that's why we are going to be talking about that today and hopefully answering those questions that you have. So let's see here if I can move on to the next slide. Ryan, it doesn't look like I quite have control yet. Maybe I do now. Oh, perfect. I think that we somehow went too far ahead. So we're going to cover a couple of things today. One, the importance of saving for college, some basics of 529, and just a little bit about choosing the right 529 plan. So before the webinar started, Ryan and I were actually talking about Halloween coming up and what our kids are going to be for Halloween. Ryan and I both know that college is very expensive. It's not something that many people can just go out and write a check and pay for. So just like creating a retirement plan, you also need to think and talk to a financial advisor and create your college savings plan. So in the United States, the number 2 goal for a family behind saving for retirement is helping pay for a child's education. Yet so many people out there don't know how to properly go about it. And there are much more efficient ways that we can go through it and help create that plan and help you meet those goals that a lot of families have. So We're going to move on to this next slide here. I apologize. Hopefully, okay. Ryan, I'm going to give you the controls here and just let you know when to move on to the next slide. So if you want to go over to slide 5 for me. So when families pay for college now, this number has actually been getting a lot better. Most families are helping pay for a student's education by using cash, money coming out of savings accounts, checking accounts, and CDs. And here we are in late October 2021. We know interest rates are very low, and we're not earning a lot of money on these savings, checking, and CDs. So is there a better way, a more efficient way to help save for college? And finally, using a 529 plan, a tax-deferred, tax-beneficial way to save for college is now the number 2 way to help pay for college. Families oftentimes have to tap retirement plans, 401k accounts, their IRAs, other taxable investments to help pay for college. So we're going to help talk about the different investment vehicles out there and help you decide what is probably best for you. Most families are electing that 529, which we're going to talk about further in detail. So the biggest benefit of a 529 plan from the investment side and the savings side is that money grows tax deferred, meaning while the money is in that investment account and investment changes are made, and hopefully you're making money, you're not paying capital gains tax along the way. And then when the money comes out of a 529 for a qualified education expense, and we're going to answer what a qualified education expense is, the money comes out completely tax and penalty free. So you got all those years of tax deferred growth, the money comes out with no tax and penalty. It was used to pay for a qualified education expense. And so let's go to the next slide. So we know college is expensive. It's talked about in the news a lot. Anytime it seems that there's an election, college is always a hot topic. The amount of student loan debt out there, which right now exceeds more than $1.7 trillion of student loan debt in the United States. The average student finishing school is finishing school with more than $30,000 in student loans. Now, we know college is expensive. College is going to continue to get expensive. Here are the numbers today for in-state of little Johnny or little Susie want to go to the University of Wisconsin in Madison. We're talking more than $25,000. Over 4 years, almost $110,000. What if they would like to go out of state? What if they want to go to a private school? Well, go down to the bottom and take a look at how much MIT, Villanova, we're talking nearly $75,000 a year, nearly $300,000 over 4 years. And most students these days are not finishing school in 4 years. It's oftentimes taking 4.5 to 5 years. More and more students are taking classes beyond that 4-year degree and going out and pursuing MBAs, master's degrees, and there's an extra cost to that as well. So point being, college is expensive, and we know that it takes a plan to help get to those hurdles that you need to work on for years and not just pay for right away. So let's move on to the next slide here. And we're not going to focus on this. We touched on it with the last slide. We know college is expensive. Take a look at those numbers, and we just put a 2.2% inflation rate on those costs of college. Here's how much if little Johnny, just born today, might expect to pay for Wisconsin or NYU, New York University, a private school, 18 years from now at that inflation rate. So it's very likely that Wisconsin-Madison could be more than $160,000 in 18 years. That is a large sum of money. So we're going to continue to talk about how to hopefully help hit that hurdle and knock out a lot of that payment. So let's go to the next slide. One resource that I want to tell you guys about right away, that this is open to anybody that hops on the webinar. We have a great resource on the Voya Tomorrow Scholar website. That's tomorrowscholar.com, where you can create a college funding plan. You can enter in any school that you would like your child to go to. All of the costs are in there. You can also calculate, maybe you don't want to pay for 100% of Sally's school. Maybe you want her to have some skin in the game and you're going to cover half of her college costs. You'll be able to enter in how much you've already saved, and they'll be able to help you figure out, here's how much we need to save per month, per quarter, per year to help us hit that goal. It's a tool that Ryan has access to that he can help walk you through. So please, if this is important to you, have a conversation with Ryan, help him put this plan together. This is one of the resources that he's going to use, just like creating a retirement plan, to help create your college funding plan. And that's available to anybody out there if you want to go out and play with it this afternoon, this evening when you're sitting around the dinner table. So let's move on to the next one.
Yeah, Dan, just to hit on that point, that tool is amazing. That thing has been great to use.
Thank you. So we're going to go through some of the basics of the 529. We're going to get into this so you guys can start to learn what these are, what they can be used for. So a little bit of history. We're coming up on 25 years of 529 plans. They were created by the IRS about 25 years ago. It's section 970, publication 970 of the IRS code. And they were created to help alleviate some of the stress of paying for college. 529 plans were originally prepaid tuition plans, meaning you could prepay for credits at the University of Wisconsin, any of the Wisconsin schools. If you knew little Johnny was going to go to Michigan, you could prepay for Michigan schools. But guess what? Just because you have 3 generations of Badgers in your family, every once in a while you have a child that might want to go to a different school. So these prepaid tuition plans weren't that efficient. There were a lot of holes in them. So if they became more open architecture, meaning that you're going to be able to save a pool of dollars, let it grow tax deferred, come out tax and penalty free for any qualified education expense post high school. And it's now changed to include a lot of other expenses as well. So these are the most common questions that we get on 529 plans. So number one, can 529 plans only be established in the state of residence? People ask me all the time, Dan, I live in Wisconsin. Can I only use the 529 plan that Wisconsin offers, yours, or the one by Tia Krep Edvest? And the answer is no. You can use any state's 529 plan. Can the beneficiary only attend a school in the state that sponsors the 529 plan? Absolutely not. To my comment earlier, if you use the Wisconsin plan, you don't need to go to Wisconsin. You can go to any accredited university in the United States. That's any school that accepts financial aid. In fact, there are many schools abroad outside of the United States that will let you use the 529 plan, and it's a qualified expense. It is very open. So if it's going to be a school like MATC or Blackhawk, a 2-year technical school, those are qualified as well. Is the owner the only person eligible to contribute to a 529 plan? No, absolutely not. This is what's great about 529 plans, and also something that Wisconsin has done a great job on. Anybody can contribute to anybody's 529 plan, make that contribution, let the money grow tax deferred, and here in Wisconsin, get a tax deduction. If you live in Wisconsin, you write a check to the Wisconsin plan, you're also eligible to get that tax benefit. Perfect example, I'm trying to do this for Ryan. If he wants to make a contribution to my son's 529 plan, he absolutely could do so. I will give him my address later and he can send that check in. So is the beneficiary limited to only one 529 plan? No, that's not the case. And we're going to talk about some reasons why a beneficiary, most likely a child, should have more than one 529 plan, meaning there's reasons why mom and dad should have their plan. And then there's also reasons why grandma and grandpa should have a plan, all for that benefit of one child, having separate ownerships, 2 plans, 3 plans if there's aunt and uncle involved, so on and so forth. Next question, who owns the funds? And does this change when the beneficiary goes to college? This question comes up a lot because of old custodial accounts, UGMA or UTMA accounts, if those acronyms sound familiar to anybody. So when you have a custodial account, when the child hits age of majority, 18 or 21, depending on the state, the money becomes theirs. And little Johnny, at that point, if he wants to go buy a Harley and get an armful of tattoos, there's nothing that mom and dad or grandma and grandpa can do because it's now that child's money when they hit age of majority. One of the great things about 529 plans is that the owner always has complete control over that asset. The beneficiary never has any right or claim to the money. The beneficiary is not able to call the 529 provider. They are not able to call Ryan, your financial advisor, and request a withdrawal. That has to come from the owner. The beneficiary has no right or claim to those dollars. What if the beneficiary does not go to college? What happens to the money? Is it lost? Absolutely not. There's no time limits. There's no expirations on 529 plans. So you can let this money continue to grow tax deferred and take advantage of that very powerful tool. You can change beneficiaries. So if little Johnny decides that he doesn't want to go to school, you could change the beneficiary to your other grandchild, your other child, your other niece, your other nephew, and change it to little Susie and help her pay for her education. Or you could let the money continue to grow. If mom and dad on the 529 plan, their son or daughter doesn't go to school, I know mom and dad are always hoping for future grandkids. Let that money continue to grow. And now you have a nice pool of money saved up for when you get that grandchild to help them pay for their education. That's what we see happen a lot. What if all the money in the 529 plan is not used? This goes to the earlier question. You have flexibility. You can change beneficiaries. We're going to talk about it in a little bit. You can even take this money out for yourself if you ever needed to and have access to it. You always have access to your dollars as the owner. And we'll talk about what happens if it is a non-qualified withdrawal. And are there any uses or benefits to owning a 529 beyond education savings? Yes, there actually are. There's a lot of trust and estate planning advantages to 529 plans, which that would be a separate conversation to have with Ryan and myself. Ryan always has access to me, bringing me into conference calls. So if we're talking about larger estate planning cases, there's some things that you can do with 529 plans to help you get below the estate tax threshold. But we could have a completely separate 2-hour webinar on that, but that's not what we're here for today. So let's go on to the next slide. So 529, what counts as a qualified distribution? Meaning qualified distribution. When the money comes out of these tax and penalty free, it can be used for these separate things. So for college, it can be used to pay tuition, all the associated fees, your supplies, meaning your books, your pens, your pencils, your folders, whatever else you need to pay for college. Equipment, because in today's day and age, you know that you're going to buy an iPad, you know that you're going to need to buy a laptop. If you're, for example, being an engineering student, you're going to have to buy software, different things to help you get that degree. That's all a qualified expense. You can also now use the 529 plan. This went into effect in 2019 as part of the Secure Act. You can use it to pay up to $10,000 for kindergarten, K-5 through 12th grade tuition per beneficiary per year. So here in Wisconsin, the name that just pops in my head, if you're in the Waukesha, Wisconsin area and you have a student that goes to Catholic Memorial High School, for example, or Marquette High School in Milwaukee, you could use the 529 plan to help pay that tuition bill up to $10,000 per year. Two other things that have changed in the 529 plan, because these things are always evolving. These things are always getting better over the last 25 years and continue to get better. You can now use a 529 plan to help pay back student loans. You can pay back up to $10,000 in a beneficiary's lifetime towards student loans. The other big thing that really opened up 529 plans and was one of the hurdles that some families had, you can now use the 529 plan to help pay for trade schools and apprenticeships. So maybe little Johnny's going to MATC to become a plumber or a carpenter, but he's also part of the union, and there's classes and there's costs associated with that. You have to go and buy tools, things like that. Guess what? You can use the 529 plan to go and pay all of those expenses. In the back of my mind, I'm thinking I'd kind of like to go back to school to maybe become a mechanic, and now all the tools that I have in the garage for my car, hey, if I could pay for those tax and penalty free, that sounds, I might call up Snap-on and get some new stuff for myself. So lots of different ways to use the 529 plan. I like to use the joke that you can use the 529 plan to pay for anything associated with college, except for the beer and pizza on a Friday night. It will cover all the expenses that you think are associated. So I'll pause there. Ryan, do you ever get any questions on that, on what you can use it for, anything that can provide any extra clarification on there? Because that's always a hot topic.
Yeah, I mean, those questions, I think on those two slides are the most important questions. Is the number one, what school can they use? Do they have to use in-state school? I always get that. what is considered a qualified education expense. They don't know how to do that. Maybe you can talk about, I might be jumping ahead on how you account for qualified expenses, like how does somebody use the funds to pay for these qualified expenses?
That's a great question. So with the 529, there's 3 different ways that you can have checks made payable. We could request a distribution. So Ryan requests the distribution, or you as the owner, not the beneficiary, calls into the 529 plan provider and says, I need X amount of dollars for this. We can send the money to the owner. We can send the check to the beneficiary if you wish. Or in the case of tuition and fees and other associated costs, you can also have the money sent directly to the university. So those are the 3 ways that you can request a distribution and make it payable. Now, for your own personal record keeping, when a distribution is made from the 529 plan, a 1099-Q is generated. That 1099-Q will be sent to the owner if the check is sent to the owner, or that 1099-Q will be sent to the beneficiary if it's requested that the check gets sent to the beneficiary. That is the tax form that's generated when a distribution is made. Now, when you make a contribution, because if you're in Wisconsin and you use the Wisconsin plan I mentioned, you'll get that tax benefit. No tax forms are generated for a contribution. So when you fill out your taxes, you just say, I've put in X amount of dollars in the 529 plan, you get your deduction. If you were ever to be audited, you would have proof that you wrote that check out to the 529 plan provider, account number, everything there, and you have your statements as well. When you're taking money out of the 529 plan for those qualified expense, I always recommend just keep the receipts. If you ever did get audited and you need to prove something, keep your tuition statements. If you go spend $1,000 on a laptop, keep your receipt for the laptop. So everything, just tuck it away in a folder. That is your proof. 529s and things of this, they're self-reporting, but just in case, the more records you have, the better. Does that answer your question, Ryan?
Yeah, that was great. Thanks.
Perfect. So let's talk about what if the money is not used or not needed for education. So maybe you don't have another child or another grandchild to change the beneficiary to. Well, a withdrawal that's not used for college is considered non-qualified, and there's certain tax consequences to that. So you still have all the years of tax-deferred growth, which is a very powerful thing. But if the money comes out for a non-qualified education expense, then it's the gains portion, not your principal. The amount that you put in always comes back to you free and clear, similar to if you're familiar with a Roth IRA. But on the gains portion, the money you've made, which making money is always a good thing, you will be paying ordinary income tax plus a 10% penalty only on the gains. And when you make a non-qualified or even a qualified distribution, the money comes out pro rata, meaning it's a combination of principal plus gains. You can't target all the gains, you can't target all the principal. It's a combination of both depending on the growth that you've had in your account. Now, there are 4 different ways to avoid the 10% penalty. So there's some flexibility with 529 plans. So number 1, let's start happy. It's always a good thing if your child, grandchild, whomever gets a scholarship, you can take out dollar for dollar the amount in the 529 of that scholarship. So if little Johnny is going to be the future star quarterback of the Badgers and gets a $27,000 per year full ride scholarship to Madison, you could take $27,000 per year out of the 529 plan, and that 10% penalty would be waived. You would only be paying the ordinary income tax on the gains. You enjoyed years of that tax deferred growth, and you got a tax deduction on those dollars you put in, assuming you're living in the state of Wisconsin using the Wisconsin plan. The second way to avoid the 10% penalty is if the beneficiary would pass away. Now, you hopefully have the ability to change it to another beneficiary, but if the beneficiary does pass away, you can take the money out of the 529 plan, the 10% penalty is waived. This third one is very unique. It's disability of the beneficiary. And the IRS, the wording for publication 970 is very gray, vague language. where disability is defined as being unable to lead a normal life and unable to make fruitful gains, meaning a disability could be something like a learning disability, ADD, ADHD, dyslexia, all the way to disability, being wheelchair bound, Down syndrome, autism, everything in between. So if you're familiar with long-term care, it doesn't work like that where you need to hit 2 out of the 6 ADLs or activities of daily living to qualify for a disability. The way that this can be beneficial is with the 529 plan, you have flexibility where you can change beneficiaries as often as you want, as many times as you want. You can even be the beneficiary of your own 529 plan. So for example, maybe grandma and grandpa are saving the 529 plan for a grandchild, but grandma and grandpa experience some sort of financial hardship. They need to help pay for some in-home nursing care, or maybe there's an emergency at the house and they need to put a new roof on, but grandma or grandpa have some sort of disability. Well, you could change the beneficiary to yourself on the 529 plan, make a withdrawal, and that 10% penalty would be waived. So it's one of those extra things that this is the value that Ryan and financial advisors provide, is giving you those unique outside of the box ideas to use these and make them as powerful as they possibly can for you. So disability waives the 10% penalty. Also, newly created ABLE accounts. So ABLE accounts were created a few years ago. They stand for Achieving a Better Life Experience. They're for individuals that were diagnosed with a disability before the age of 26. You can roll over assets in a 529 plan to an ABLE account without any tax consequences. Now, ABLE, if you think that what I said there kind of ringed a bell, or you know somebody that has a child or even a young adult or even an older adult, as long as they were diagnosed with that disability before 26, there's a lot of benefits to ABLE accounts. And again, I could do a separate 1 to 2 hour webinar just on ABLE accounts, but just know that if that is something that triggered a thought for you guys, please reach out to Ryan. He can work with me and we can figure out what the best solution for you is and help educate you on what ABLE is, because it's very new to the tax code. And then I've already mentioned these, the possible alternatives to a non-qualified withdrawal. In most cases, we're trying to change beneficiaries, help pay for another child's education, but we can always just continue to let this account grow. Tax deferral is a great thing and helps get those account balances larger down the road. Let's move on to the next one. I'm not going to spend too much time on these next 2 slides. They walk through what taking a distribution with a tax penalty looks like, what taking a distribution without a tax penalty looks like. So in this example, we just put a $50,000 contribution in the 529 plan. It grew, it became $100,000. A distribution needs to be made. So somebody at a 22% tax rate plus a 10% penalty, you're paying $16,000 in tax and gains. That's this slide. If we go to the next slide, just remember the $16,000. This next slide is that same example, but we had one of those 10% penalty waivers. So little Johnny got a scholarship. Maybe there was that disability waiver that we mentioned earlier, but you can see that now the total taxes paid is only $11,000. So anytime you're going to make a distribution, always work with Ryan. Let him know why you're making that distribution. And we will try to make things as beneficial for you as possible to help you retain as much of those dollars that you've invested and grow.
Hey, Dan, just to clarify on this topic, not to dive too far into it, but I do hear that quite a bit. Like, what if we don't use the money for the kids or whatever, and we want to use it ourselves? Just really quick, explain that pro rata part of it really quick again.
You got it. So pro rata is when money comes out and it's a combination of the principal, your contributions, and a combination of the gains. So this example, and I like that we're using easy math here, I can figure this out even. So we put $50,000 in, it grew to $100,000. So 50% of the account is principal, 50% is gains. We are going to take out the entire account here. So that $50,000 is going to be what's subject to that 10% penalty and gains. Let's say that in this example, let's say we only took out $20,000. So if you say, Ryan, please make a $20,000 withdrawal from my $100,000 account. When you make a $20,000 withdrawal here, again, because it's 50% each, $10,000 will be principal, $10,000 will be gains. That is how you get your $20,000. Pro rata just meaning a combination of principal and gains.
Perfect. And my point in that, what I always tell people to simplify or to conclude it here, is pro rata is good. Pro rata is better than not pro rata.
Yep.
All right, so we can move you on there, Dan.
Perfect. So let's talk about financial aid, because we all want to get access to as much free money or beneficial money as we possibly can. So when a child goes to college, this acronym might be familiar to everybody. You're going to fill out what's called the FAFSA form, the Federal Application for Financial Student Aid. So any university is going to ask for you to fill out a FAFSA form, and you'll also fill out a financial aid form that might be specific to that university. The FAFSA form is going to calculate a couple of different things, and I'm going to touch on this as well. It's not on the slide. FAFSA is changing for the better, because anybody that has filled one of these out, it's about 300 questions on the FAFSA form. It'll take you 4 or 5 hours the first time you do it, and it is an absolute nightmare and headache. They're shortening it to about 70 questions. They're going to be looking at a lot fewer things. So if you're creating the college savings plan, there's some things that we can do to help make your FAFSA be more appealing, hopefully help you out. But FAFSA is going to calculate a cost of attendance. So how much for 1 year of school is the tuition, the room and board, and the related expenses for that school. It's going to calculate an expected family contribution. This is the amount, just as it says, that a family should be able to help contribute and pay towards that child's education. And that's the expected family contribution is going to be based off of what you have for assets, what you have for income, what the child has for assets, what the child has for income. That's all going to create the expected family contribution. So you put those two together, and now we figure out what is the financial need. And that is how the financial aid is determined. The greater the financial need, the higher likelihood of receiving financial aid. So we want to do things to get this expected family contribution as low as possible. The less that a family is expected to contribute, the greater the financial need and the greater likelihood of getting financial aid. Next slide. So how are 529s treated when calculating financial aid? Well, 529s, again, these were created by the IRS 25 years ago as the goal to be the most efficient way to pay for a child's education. So 529 plans are most commonly owned by a parent, guardian, and then secondarily by grandparents, aunts and uncles, other family members. So when assets are in a 529 plan, and I'll also mention that we have a great piece that Ryan can forward to folks on financial aid that goes through all of this in greater detail, or have a conversation with them. When mom and dad own a 529 plan for a child, it's going to impact the expected family contribution by roughly 2.5% to 5.5% on the financial aid. When there's a distribution coming out of a 529 owned by mom and dad, has no impact on the 529. If it's owned by grandma and grandpa, FAFSA uses a 2-year look back on assets and income, so it could be potentially treated higher. When you create that initial FAFSA form, you fill it out for the first time, it only looks at parental assets and parental income, student assets and student income. So any 529s that are owned by grandma and grandpa, aunts and uncles, don't show up on that initial financial aid form. It's not until after 2 years that money started to come out of it where it would ever show up on the FAFSA. So the old way, prior to 2021, the old basic financial plan was you always wanted to use mom and dad's $529 first, and you wanted to save any non-parental loan, grandma and grandpa, aunt and uncle, godparent 529s. You want to save that for the last 2 years of school, because that way it won't show up on that financial aid form, because FAFSA uses a 2-year look back on income. But I mentioned it a few minutes ago that FAFSA, financial aid, is changing for the better. One, it's becoming a much shorter process, getting down to only about 70 questions. And it is no longer going to be looking at any 529 distributions from those non-parental 529 plans. So it sounds like, and I say sounds like because this hasn't gone into complete effect yet, it's scheduled to go into effect in 2022 for the 2023 school year. And we know in Washington, things can change. So make sure you clarify with Ryan what the current rules are in case they do change. There's going to be a lot of benefits to have 529 plans owned by grandparents and non-parents because they won't show up on the FAFSA form. The distributions, the income of those will not be counting. So when you create that financial savings plan, when you create that college savings plan, that's a conversation Ryan's going to have with you. How do we structure this to make this most beneficial? And do we get grandma and grandpa involved to help possibly make this more favorable for you guys? So this is, again, why I say grandma and grandpa should own a 529 plan. Mom and dad should own their own. In my house, for my son, I have a 529 plan that I own for my son. And my mom and dad have a separate 529 plan that they make a contribution to as well. So there's lots of benefits to both. And in the future, if there was ever something that my mom and dad, my son's grandparents, needed, if they need to tap that asset for some life emergency, now they don't need to come back to their son. They don't need to say, Dan, is it okay if we take a few $1,000s out of that 529 plan that we've been saving for your son, Benjamin? It's their asset. They own it. They can do whatever they want. So let's go on to the next slide, unless, Ryan, you know there's a question that you get asked a lot.
No, keep going. You're doing good.
Perfect. So I already mentioned already, there's a lot of resources that we have here at Voya on college savings and 529 plans. This is one of the white papers, research papers that talks more in depth about financial aid. If that's something that's of interest to you, shoot Ryan an email. He will get that sent over to you right away. Next one. So it's never too late to start savings. This is actually one of my favorite examples because I'm personally going through it right now as I'm out there shopping for daycares. So let's say you have a child that's in daycare and it costs you $1,000 a month, which is actually probably cheap for daycare. I'm quickly learning. But all of a sudden your child's 6 years old, they no longer need to go to daycare. They're in K-5, they're in first grade. And now this is great. Parents look forward to this day when they have that extra $1,000 a month to go and do something. They start to get a little breathing room. Well, what if we took that $1,000 a month that you were paying for daycare, instead of going out and buying something else or going on that vacation, you kept paying that $1,000 a month, but you put it in a 529 plan and you took advantage of that tax deferred growth. So this is $1,000 a month contribution. Little Johnny's age 6, so 12 years of growth at 6% a year. Guess what? When he's 18 and ready to go to school, we now, in this hypothetical, have $210,000 for him to go to college, which will cover a lot of schooling. Hopefully even him going on, if he has to go for 5 years, going out and getting that grad degree, you now have a very, very nice pool of money to help pay for a child's education. If you just take that daycare contribution and then you reallocate in the future for the 529 plan, you don't, hopefully you do, but it is never too late to start this. Absolutely not. People ask me all the time, my student's a freshman in high school. Is it too late to do this? Absolutely not. If you know you're going to help pay for their education, why not put it in a more tax advantaged vehicle and at a minimum get yourself the tax deduction if you live in a state that offers a tax benefit. So take advantage of that if you know you're going to help pay for a child's education. It's never too late. Let's go on to the next one. So this is another example. I won't go too deep into this, but let's say a year of school costs $37,000. So this $1,000 a month in the previous slide, $1,000 is a large sum of money. This is a little more palatable and reasonable. This is if somebody just did $100 a month. $100 a month growing at 6%, you're going to invest, save $21,500. Over 18 years, you'll have earned $15,500, getting you to that $37,000. But let's say you did nothing, and now either you as the parent or grandparent need to take out a loan, or your student's going to go take that loan out. Well, to take out a $37,000 loan in current interest rates, which are actually conservative here, they're going to spend more than $13,000 in interest on that same $37,000. So what's better? Saving $100 a month to get to $37,000, or taking a $37,000 loan, which is going to end up costing you more than $50,000. Back to the original point when we started this, a little bit consistently can go a very long way. Next one. So for a 529 plan, how much can you contribute to these things? It follows IRS annual gifting limits, meaning an individual can put in $15,000 per year. A couple filing joint can do $30,000 per year. 529s are completed gifts, meaning they are immediately removed from your estate. You still have complete control over them with the 529. That's a big benefit. But 529s are also the only investment vehicle that allow you to do 5 years worth of accelerated gifts, meaning basic math. An individual filer could put $75,000 in right away. A couple filing joint can do $150,000. So you can get a lot of money into these right away. If somebody wanted to go above and beyond that, if you wanted to do more than $75,000 or $150,000, you can. You can get more than $500,000 into a 529 plan. You will just then be tapping into your lifetime gifting exemption. And again, this is a conversation that you would have with Ryan. I hop on these types of calls all the time, and I'd likely be involved in that as well. And we'll walk through everything, how it impacts your estate plan as well. Point being, you can get a lot of money into these right away if you would like to. Next slide. And this just goes, this next slide is how a family can get a lot of money into these things. So if you are trying to reduce an estate, this is more of these advanced cases. Grandma and grandpa, maybe they're very high net worth and they're trying to get rid of some money, trying to gift some money. You can see the 529 can create a lot of tax deductions, create a lot of benefits, help get assets out of your estate to avoid those potential estate taxes. Next one. So let's do a quick comparison over some of the other historically popular ways to help pay for a child's education. So there's 529 accounts, which the IRS created 25 years ago. Prior to that, there were Coverdale ESAs or education IRAs. I've heard them talked to about with that name quite a bit. Custodial accounts, those are the UGMAs, the UTMA accounts, a taxable brokerage account, or this would also include your savings account, your checking account, your CDs. With the 529, the owner always has complete control over the account. With a Coverdale account, one of the education IRAs, when the beneficiary turns 30, the money becomes theirs or the account needs to be liquidated. Custodial accounts, again, when they hit age of majority, 18 or 21, it becomes that child's assets. And then with a brokerage account, again, that's your money, so you always have complete control over that too. The 529 allows for better gifting limits. The education IRAs, you can only put $2,000 per year and you can't get a whole lot into those. Brokerage account, it's your own money, so you're just directing how it's distributed with that. The earnings on the 529 plan, again, if it's coming out for qualified expense, it's coming out tax and penalty free. You can see the different taxes that you would pay on the others. Are the distributions tax free? Yes, with the Coverdale, the education IRA, and the 529. No, with a custodial account and brokerage account. Does it offer state tax benefits? Yes, we know 529s potentially could do that. Penalty, if it's a non-qualified withdrawal, Coverdales have that same penalty as well. 529s, we talked about that and how to avoid that possible 10% penalty. You can change the beneficiaries on the 529 plan. With the custodial accounts, once you've locked in a beneficiary, there's no changing the beneficiary on those. So people ask that often. Be clear if you're considering a custodial account or a UGMA, UTMA account. The joke that Ryan and I and other financial advisors, people that have poor senses of humor, we call them "you give money away" accounts, because once the child hits 18 or 21, it becomes theirs. A terrible financial advisor joke. Using them for qualified education expenses, college expenses, yes, you can do that with all. Money coming out tax and penalty free for primary and secondary school. For the 529, K through 12, private tuition, we know that. And then tax free for college expenses. We know that the custodial account, we know that the brokerage account. You're going to be paying some gains. You're going to be paying capital gains. Hopefully you've earned some money and there will be tax consequences for you. Where the 529 plan, no, if it's for qualified education expense, it's coming out tax and penalty free. So let's go on to the next one. And I promise you, we just have a couple slides left here. Again, this is a little bit to the last slide. I'm not going to go into too much detail because I know we're getting close and running up on time. But the 529 plan checks all of those boxes. There's no income restrictions. There's no phase outs. Anybody can contribute to a 529 plan, high net worth or a new family just starting out. You can start with as little as $25 a month into a 529 plan. You can get a lot of money into the 529 plan as well, completely the opposite. We talked about that just a few minutes ago. The earnings and withdrawals are coming out tax and penalty free. We know there's potential state tax deductions here in Wisconsin. We talked about that one. If you live in another state, if you live in Illinois, Michigan, Iowa, wherever, there's potential tax benefits for you as well. Talk with Ryan about where you live. They'll talk about the 529 plan that state offers, and if there's a tax benefit, it'll oftentimes make sense to use that state's 529 plan. Very important, 529 is the owner always has complete control over it. Again, the beneficiary never has any right or claim to those dollars. They can't request the dollars. You own it, it's your money, you control it. And you can have flexibility. You can change the beneficiary on these as often as you want, as many times as you want, as long as it stays in your original family tree. Meaning the 529 plan that I have for my son, I can change the beneficiary to my stepdaughter. I could change the beneficiary to my cousin. I could change it to my niece, my nephew, if my future, I'm sure if my brother had children, I could change the beneficiary to his children. I could change it to my parents. I could change it to my grandfather. Anybody in your original family tree, you can change the beneficiary to. So these have a lot of flexibility and continue to grow and get better over the years. Next slide. This is a conversation, if we're talking about 529 from estate planning standpoint, lots of benefits there. We're not going to get into the details. We're going to go real quick on choosing the right 529 plan. Here in Wisconsin, so Voya, we do a great job with the 529 plan. The state of Wisconsin selected us almost 10 years ago to take over and do the 529 plan for the state. So a big responsibility. We won that over a lot of our peers in the industry, so very proud of that. We've done a great job with the 529 plan here in the state. We're one of the top performing plans in the country. If you are interested and you want to talk more about Ryan about this, he will tell you the extra details and benefits of making sure you pick the right 529 plan for the state that you reside in. Next slide. So just to kind of wrap it up, when you have that first conversation with Ryan, he's going to help you determine your funding needs. He's going to create that college savings plan using the tools at his disposal. We're going to figure out where we can, pull the money from. How are we going to get those contributions in there? And if it's mom and dad, if it's grandma and grandpa, we're going to try to loop in the entire family here because there's benefits to everybody making contribution that cares about that child that wants to help pay for their college. So if it's mom and dad, it makes sense. Let's have a conversation with grandma and grandpa and aunt and uncle. I know in my house, I don't need any more toys in my house. I don't need any more Legos in my house. So I would much rather, when we get to Christmas time in a couple months, I would much rather contributions go to my son Benjamin's 529 plan than get another toy that I'm going to take to Goodwill in 6 months. Then we're going to figure out what the right 529 plan is for you. Get that account open, start making those contributions, and start helping take care of that child's future education. So in closing, this is Joe Hurley is big in the 529 industry. He always says that 529 plans are intended to serve one purpose, providing a way for families of any income level to save for future college costs in the most effective way possible. But these have investment, tax, retirement, and estate planning abilities that reach far beyond than that one original purpose. So the industry is growing. More and more people are becoming educated on 529 plans. Hopefully that continues and we can continue to get more. So Ryan, that concludes my remarks there. I don't know if we want to open it up for questions. If there is a question that you have that you want to make sure that gets answered that perhaps I missed, let me know how I can be a resource to you guys. And thank you, Ryan, for putting this together. I love doing this.
Yeah. Thank you, Dan. Yeah, I guess this, when I was looking at this presentation before we did it, this one line is what I've been really trying to tell clients and prospective clients all along, is that 529s are very versatile accounts, obviously mainly for college funding and college expenses, and but they have all these other purposes and flexibility to them for retirement planning, estate planning. So, kind of a Swiss Army knife type of accounts. And there's only a few of those really out there, I think it should be in every conversation. Shouldn't be poo-pooed as much as I think sometimes it can be, just because people might not know as much about it. So I appreciate you going through all of these nuances of the 529s. There's a lot to go through. So for anybody watching this, there will be a recording, that you can go back and pick up some more tidbits of this. But as I kind of conclude here, for clients, you guys know how to get in touch with me. If you want to have a more of a detailed conversation on a 529 or whatever, you guys know how to reach me. You can set up a meeting. We can talk about that. For those of you that are on here who might be friends of clients, everyone will get an email or two things. Everyone will get a survey that pops up after this webinar that'll give you two options to either click here, it says. That will go directly to my calendar where you can set up a meeting, match up with your calendar at a time that works for you. Or you can fill out the survey and say, yes, I want to just do a quick meeting with you, Ryan, but I don't have time to match up my calendar, so give me a call. So just put your email or phone number and I'll reach out to you. This is what it kind of looks like for those of you who haven't gone through this kind of online scheduler. Existing clients, you can go right here. It's the same tactic. Same process, but if you're new, you can go through the complimentary assessment. There's no cost to just have the conversation about this type of thing. And then you can match it up with your calendar. It'll have all the dates that are open on my calendar, so you can put in all of your information and set up a time directly. If you forget to do that, or if you jumped off early or clicked out of the browser, there will be an email coming right after this webinar as well that'll have that same opportunity there where you can do the complimentary consultation or link to the survey. So just wanted to let you know that. Here's the disclosures on everything. Thank you very much for participating. I think we will wrap it up there. What do you think, Dan?
Sounds good. Thank you, everybody, for taking the time. Thank you, everybody, for watching the recording. And Ryan, again, thanks for setting up.
Yeah,
look forward to being a resource to anybody out there in the future.
Take care.
Thank you.